We're constantly hearing about new digital frontiers being built with blockchain technology.
Yeah, all the time.
But have you ever stopped to think about the engine that actually powers these worlds?
Hmm, the mechanics behind it all.
Exactly. Today, we're diving deep into the tokenomics of the Sui blockchain.
Okay.
Think of it as understanding the core economic design that makes it tick, and crucially, why it's built the way it is.
Right, the why is key.
Yeah.
We're zeroing in on the SUI token, which is the fundamental economic unit within the Sui network.
SUI, okay.
Now, tokenomics might sound like a mouthful, but it simply refers to the economic principles that govern a blockchain, and our focus is on its native token.
Gotcha.
In Sui's case, SUI acts as the network's currency. It pays for the processing power, what we call gas fees,
Right, I guess.
and even covers the cost of storing data on the blockchain.
And to really get under the hood, we've been digging through the official Sui documentation.
The source material, yeah.
Our mission today is to extract the essential insights into how SUI works
Yeah.
and the economic incentives that are built right into the Sui network. We want to make these core concepts crystal clear for you.
Sounds good. Make it accessible.
Okay, so let's unpack this. Sui uses something called proof of stake, or POS. What's the core idea there?
Right. Proof of stake. It's a mechanism that allows the network to agree on and verify transactions securely.
Securely agree, okay.
Think of it this way. Instead of relying on energy-intensive mining, like, Bitcoin,
Yeah, well,
Sui uses participants called validators. These validators lock up a certain amount of SUI, their stake, as a form of collateral.
class.
By doing so, they become responsible for validating transactions, and in return for their honest work, they earn rewards.
So it's like they're putting their own money on the line to ensure everything runs smoothly.
Precisely. Skin in the game.
Oh.
And it's not just for the big players. If you hold SUI, you can actually choose a validator and delegate your tokens to them.
Delegate, like lending my SUI.
Kind of, yeah. You're lending your staking power. In return, the validator shares a portion of the rewards they earn with you, based on the amount you delegated.
Okay, so I get a cut.
Exactly. What's interesting is that the end of each epoch, and an epoch in blockchain terms, is essentially a fixed period of time.
How long is that in Sui?
In Sui's case, it's 24 hours, during which certain network activities and calculations occur at the end of that epoch. You have the flexibility to withdraw your SUI or even switch to a different validator if you choose.
Okay, so we have validators putting up their own stake, and then users can delegate their holdings.
Yeah.
Who else are the key players in this Sui economic system?
Good question. There are three main groups of stakeholders, and each has a real interest in the long-term health of the network.
Three groups, okay.
First, you have the users. These are the individuals and applications that are actually interacting with the Sui platform, submitting transactions to create and move digital assets, or using the various decentralized applications built on Sui.
Makes sense. The people who are actually utilizing the technology,
Yeah.
the end users.
Then you have the SUI token holders. This includes those who stake their tokens, as we just discussed, to participate in securing the network and earning rewards.
Right, the stakers.
But crucially, owning SUI also grants you the ability to participate in Sui's governance.
Governance.
Yeah, you essentially get a say in important decisions about the future direction and upgrades of the network.
So it's not just about holding a digital asset. It comes with a voice in how the network evolves. That's pretty important.
Exactly. And finally, we have the validators themselves.
The ones doing the work.
They are the entities responsible for the critical tasks of processing transactions and ensuring the smooth operation of the Sui platform. Because they have their own SUI staked, as well as the SUI delegated to them, they are directly incentivized to maintain the network's viability and security.
Okay, so users, token holders with voting rights, and the validators keeping everything running. Makes sense. Now, let's dig deeper into the SUI coin itself. We know it pays for gas, but it sounds like it has a few more roles to play.
It certainly does. The SUI coin has four main functions. First, as we've discussed, it's essential for staking to participate in the proof-of-stake consensus mechanism.
Staking check.
Second, it's the currency used to pay gas fees. These fees cover both the computational resources needed to execute transactions and the cost of storing data on the network.
So every interaction on the Sui network has a small SUI cost associated with it, computation and storage.
Correct. Third, SUI is designed to be a versatile and liquid asset. Think of it as a fundamental form of digital money.
How so?
Well, it can serve as a unit of account, a way to price things within the Sui ecosystem, a medium of exchange for buying and selling assets and services, and a store of value, an asset that users can hold over time.
Unit of account, medium of exchange, store of value,
Yeah.
the classic money functions.
Right. But it goes further, enabling more complex functionalities through smart contracts and facilitating interoperability with other parts of the Sui ecosystem.
So it's more than just a digital currency. It's a fundamental building block for the whole platform, like
Yeah.
the base layer money.
Precisely. And the fourth key purpose is governance.
Ah, yes, the voting.
Holding SUI allows you to participate in on-chain voting on important proposals, such as upgrades to the underlying Sui protocol. This is how the community can collectively shape the future of the network.
Interesting. So the token holders really have a direct influence on how the network develops. Now, let's talk about the overall supply of SUI. I understand there's a limit to how many will ever exist.
That's right. The total supply of SUI is capped at 10 billion tokens.
10 billion, that's it.
That is the absolute maximum number of SUI that will ever be in existence. However, it's important to realize that not all of this supply is immediately available for use.
Wow, okay.
There are carefully designed unlocking schedules in place that dictate when different portions of the total supply will become accessible.
Okay, what's the reasoning behind this gradual release? Why not just put it all out there?
Well, it's primarily to foster the stability of the network's economic system and ensure long-term security.
Stability.
Releasing the entire supply at once could introduce significant volatility into the market, you know?
Yeah, that makes sense.
Having a capped supply is also crucial for the long-term economic model, ensuring that the currency can support increasing levels of activity as more users and applications join the platform.
Right, predictability.
And what's fascinating here, actually, is that the Sui network also incorporates a storage fund,
The storage fund, yes, you mentioned that.
which can actually lead to a reduction in the amount of SUI in circulation over time as more data is stored on-chain.
Wait, a reduction, so deflationary.
Potentially, yes. This contrasts with some blockchains that have uncapped supplies, where inflation is a constant consideration.
The storage fund sounds intriguing. We should definitely come back to that. But first, you mentioned key events happening at the beginning of each epoch. What are those crucial moments?
Right. At the start of each 24-hour epoch, 3 important things happen.
3 things. Okay.
First, SUI holders can stake their tokens with their chosen validators, and a new set of validators, known as the committee, is formed to oversee the network for that epoch.
New committee every day.
Second, the reference gas prices, the baseline costs for computation and data storage, are established based on the current network conditions.
So gas prices can change each epoch.
The reference prices, yes, they adjust. And third, the size of the storage fund is adjusted based on the net inflow of storage fees collected during the previous epoch.
Okay, so it's like a regular calibration point for the network's economic engine, resetting things daily.
Exactly. After these initial steps throughout the epoch, users submit their transactions, and the validator committee processes them.
Business as usual.
For each transaction, users pay gas fees according to the set reference prices. Interestingly, if a user later decides to delete data they've stored on the network,
Oh, yeah.
they can actually receive a partial rebate on the storage fees they initially paid.
A refund for deleting data. That's smart.
Yeah, it incentivizes cleanup. Throughout all of this, the validators are also constantly monitoring each other's performance to ensure the network remains healthy and operates correctly.
Peer monitoring. Good. And what happens at the end of each of these 24-hour epochs in terms of how participants are rewarded? Payday.
Sort of, yeah. At the end of the epoch, the Sui protocol calculates and distributes staking rewards to everyone who participated in the proof-of-stake mechanism, either as a validator or by delegating their SUI.
Okay, how is that calculated?
This reward calculation has 2 main components: the total amount of computation fees that were collected during the epoch,
The gas for processing.
plus any stake reward subsidies. Now, it's important to note that these subsidies are a temporary measure.
Temporary.
Yeah, designed to support the network in its early stages and will gradually decrease as more of the total SUI supply becomes available.
Okay, so it's a way to incentivize early participation and growth of the network, like training wheels.
Precisely. The total pool of these rewards is then distributed proportionally based on the amount of stake each participant contributed.
Makes sense. Proportional rewards.
Now, going back to that storage fund we mentioned earlier,
Yes, the fund.
it plays a role here too. Even though the SUI in the storage fund isn't owned by any individual in the traditional sense of staked SUI,
Right, it's just a pool.
It's taken into account when calculating the total stake for the epoch. The economic model is designed so that the stake rewards that would have accrued to the storage fund
Okay.
are instead distributed to the active validators.
Ah, so the validators get the storage fund's share of rewards.
Essentially, yes. This is intended to compensate them for the ongoing cost of storing the network's data.
So they get paid for storage costs indirectly through these rewards.
Correct. This approach contrasts with some earlier blockchains that struggled with the long-term sustainability of data storage, often leading to concerns about scalability and the cost of running full nodes.
That sounds like a really innovative way to address the challenge of long-term data storage on a blockchain. Very clever.
It is. And this whole system is designed to create a natural incentive for validators to set their gas fees at a competitive yet sustainable level.
How so?
Well, if fees are too high, users might be discouraged from using the network, right?
Well, too expensive.
But if they are too low, validators might not have a viable economic incentive to continue operating.
Okay, need to cover costs to make a profit.
So there's an inherent pressure towards finding a healthy equilibrium, a balance.
You mentioned earlier about unlocking schedules for the SUI tokens. Could you elaborate on why those are put in place and why they're important for a project like Sui?
Absolutely. Unlocking schedules, also known as vesting schedules, are predetermined plans that dictate when and how certain portions of a cryptocurrency's total supply become available for trading or use.
Fantastic, right.
For a blockchain like Sui, which is focused on long-term stability and a committed community, these multi-stage schedules are quite common.
Standard practice, then.
Pretty much. When Sui launched its mainnet, there was a significant one-year cliff period that just ended in May of 2024.
A cliff. That sounds pretty significant. What does that mean exactly?
It simply means that for that initial year following the mainnet launch, all the early investors and core contributors were restricted from transferring their initial SUI holdings on the open market.
Ah, so they couldn't just dump their tokens immediately.
Exactly. It's a fairly standard practice in the cryptocurrency space to prevent the possibility of large-scale sell-offs by early holders immediately after launch,
Right, which could crash the price.
which could lead to significant price volatility and instability for the new cryptocurrency. So it's a mechanism to protect the network in its early days, promote stability.
Makes sense. It's about protecting the network from potential early instability. Now, another thing that was quite notable was the decision not to have any SUI airdrops at the time of the mainnet launch.
That's right, yeah. No airdrop.
That's different from how some other projects have approached their initial distribution. What was the thinking behind that decision?
That's right. Typically, new blockchain projects will allocate a percentage of their tokens to be distributed to early adopters or interested users
Free tokens.
as a way to generate initial awareness and foster a community. This is what's known as an airdrop. Sui made a conscious decision to forego a traditional airdrop for several publicly stated reasons.
Okay, what were the primary motivations? Why skip the free giveaway?
Firstly, airdrops can unfortunately attract individuals or groups who are primarily interested in short-term gains
The flippers.
and might try to exploit the event for their own benefit without any genuine long-term commitment to the project.
Right, people just looking to sell immediately.
By clearly communicating that there would be no airdrop, Sui aimed to mitigate the risk of these bad actors and focus on building a community of engaged long-term supporters.
Okay, focus on quality users. What else?
Secondly, the regulatory landscape for cryptocurrencies varies significantly across different jurisdictions around the world.
Oh, legal stuff.
Yeah. Airdrops can sometimes be interpreted as taxable events in certain regions, potentially creating legal and tax complications for recipients.
Didn't think of that. Avoid the headache.
And finally, Sui's primary focus has been on the long-term sustainable growth of its network and its ecosystem of builders and users.
Long game thinking.
While airdrops can generate short-term hype, the Sui team believes that focusing on building a robust and functional platform will lead to more genuine and lasting adoption in the long run.
So the emphasis was on building a strong foundation and a committed community, rather than just generating short-term buzz.
Okay, makes sense from that perspective. Let's circle back to that storage fund.
Yes, the storage fund.
It sounds like a really innovative component of Sui's design. Can you break down the mechanics of how it actually works in a bit more detail?
Certainly. As we touched on earlier on the Sui network, users pay gas fees for both the computational resources they use and for the data they store on the blockchain. Two types of fees.
Computation and storage, right? The storage fund is Sui's solution to a specific challenge. how do you ensure that new validators who join the network are fairly compensated for the cost of storing historical data?
Ah, the data that was there before they joined?
Exactly. Data that existed on the blockchain before they became validators. The storage fund acts as a dedicated pool of SUI tokens that, importantly, is designed to never be fully depleted.
Never depleted. How?
Well, whenever a transaction results in an increase in the amount of data stored on the blockchain, a portion of the gas fees from that transaction, specifically the storage part of the fee, is directed into this storage fund.
So it's constantly being replenished as more data is added to the network, fees flow in.
Exactly. Now, here's where it gets particularly clever. The storage fund itself operates like any other participant that stakes SUI on the network.
The fund stakes itself.
Effectively, yes. It has a stake in Sui and therefore earns staking rewards that are proportional to its size relative to the total amount of SUI staked across the entire network.
Okay, so the fund earns rewards like a staker.
Right. These rewards that the storage fund earns are then regularly distributed to the active Sui validators to help cover their ongoing costs of storing the network's data.
Ah, so that's how the new validators get paid for old data from the fund's earnings.
Precisely. So a new validator joining the network effectively receives compensation for storing past data, and this compensation is funded by the fees from the very transactions that created that data in the first place.
Wow, that closes the loop nicely.
It really does. This contrasts with some earlier blockchains where the burden of storing historical data could become a significant, potentially unsustainable cost for node operators.
That sounds like a very elegant mechanism for ensuring the long-term viability of the network's data storage. Really well thought out.
It is. The storage fund has a few key characteristics worth highlighting. First, as we've mentioned, it's funded by fees from past transactions,
Past users pay for future storage.
making it a mechanism for effectively shifting the cost of storage across different epochs. This ensures that those who initially created the storage requirements are indirectly contributing to compensating future validators for maintaining that data.
Okay, cross-epoch compensation.
Second, the fund is structured to only pay out the returns it generates, the stake rewards it earns.
Only the interest, not the principal.
Exactly. The principal amount of SUI held within the storage fund is never distributed. Think of it as validators effectively leveraging the storage fund's SUI to increase their overall stake and then keeping the majority of the resulting rewards.
So the base amount stays locked.
Right. This structure ensures that the storage fund retains its capital base and can continue to operate indefinitely. This is further supported by the fact that any stake rewards earned by the storage fund that are not needed to compensate validators
Leftovers.
are reinvested back into the fund, allowing it to grow over time.
So it's designed to be self-sustaining and grow alongside the network's data storage needs. Compounding growth.
Precisely. And the third key feature is the data deletion option.
Yes, the refund.
If you, as a user, decide to remove data that you previously stored on the Sui network, you are eligible to receive a partial refund of the storage fees that you originally paid.
Providing a direct incentive for users to manage their on-chain data efficiently.
Exactly. Remove any unnecessary information, which helps to keep the overall storage burden on the network manageable.
That's a really smart way to encourage responsible use of network resources, clean up after yourself. You also mentioned earlier that the storage fund contributes to a deflationary aspect of SUI. How does that work?
Yes, this is a particularly interesting aspect of Sui's tokenomics, because the total supply of SUI is capped at 10 billion tokens.
The fixed cap.
As the amount of data stored on the network grows, the storage fund will also tend to grow as it collects more storage fees,
More data, bigger fund.
which effectively takes more SUI out of the circulating supply and locks it within the storage fund.
So as the network becomes more active and more data is stored on-chain, there's potentially less SUI available in the open market, locked away.
Exactly. This reduction in the circulating supply, combined with the fixed total supply, can potentially increase the scarcity,
Supply goes down.
and therefore the store of value for SUI over time, which in turn can encourage long-term investment and holding of the token.
Okay, so the storage fund isn't just about compensating validators for storage. It has broader implications for the overall SUI economy and its potential as a store of value. Very interesting dynamic. Now, let's shift our focus to how validators themselves are rewarded.
Okay, validator rewards.
I noticed a mention of certainty over randomness in Sui's approach to validator rewards. What does that signify? What's the difference?
That's a key differentiating factor for Sui's proof-of-stake system. In many other traditional proof-of-stake blockchains, the rewards that a validator receives can have an element of randomness.
Like a lottery based on stake?
Kind of, yeah. Often based on a probabilistic selection process that is influenced by the amount of stake they hold. This can sometimes lead to a situation where larger validators have a higher probability of earning more rewards,
The rich get richer.
which can further increase their stake and potentially lead to centralization over time, compounding dominance.
Right. So how does Sui avoid that?
Sui takes a different approach to mitigate this. All honest validators on the Sui network receive their staking rewards with complete certainty.
Certainty. Guaranteed reward.
If they operate correctly, yes. The amount of rewards they earn is directly and predictably based on the total amount of stake they are managing, both their own and any delegated SUI.
So it's just proportional to stake, no luck involved.
Exactly. There is no element of probabilistic selection in the reward calculation for validators who are operating honestly and correctly.
Okay.
Sui's deterministic approach aims to foster a more stable and predictable environment for validators, potentially encouraging broader participation and reducing the risk of centralization.
So it's a more predictable and potentially more equitable system for validators, removing some of the luck involved in reward distribution on other platforms.
Interesting. Now, you also mentioned that validators operate staking pools.
Yes, staking pool.
What exactly are these, and how do they interact with users who want to delegate their SUI?
Each Sui validator maintains its own staking pool. This pool serves as an accounting mechanism.
Just accounting.
Primarily, yeah. To keep track of the total amount of SUI that the validator is responsible for staking on the network, which includes both the validator's own stake and any SUI that has been delegated to them by other token holders.
Okay, tracking your total managed stake.
These staking pools operate in conjunction with a time series of exchange rates that are calculated at the boundary of each epoch.
Exchange rates. Like between SUI and something else.
Not quite. These exchange rates are really important because they determine how much SUI a user who has staked their tokens in the past will be able to withdraw in the future, taking into account the rewards that have been earned by that pool. So the exchange rate essentially tracks the accumulation of rewards within the staking pool, like the pool's performance.
Precisely. As a staking pool successfully validates transactions and earns rewards, the exchange rate for that pool increases.
Okay.
If you deposited your SUI into a particular validator's pool in epoch-E, those tokens are effectively converted into a representation of your share in the pool based on the exchange rate that was in effect at that time.
My share of the pool.
Then, in a later epoch, say E, when you decide to withdraw your staked SUI, your share in the pool is converted back into SUI using the then current higher exchange rate.
Reflecting the earned rewards.
Exactly, reflecting the staking rewards that have accrued during that period. Now, here's a key point to understand. Unlike some other blockchain platforms, Sui does not utilize separate liquidity tokens to represent your staked assets within these pools.
No LP tokens. That's different.
Right. Instead, a global exchange rate table manages all the accounting behind the scenes.
Simpler, maybe.
Potentially. And because all SUI within a validator's staking pool, whether it's newly staked tokens or earned rewards, is treated identically.
Okay.
All of it immediately counts as stake and begins to accrue further rewards in the very next epoch. This effectively means that staking rewards are automatically compounded.
So the rewards are essentially reinvested automatically, making the staking process more efficient. No need to claim and restake.
Exactly. The formula for calculating this exchange rate at the end of each epoch, E+1, is exchange rate at E+1 equals.
Okay, math time.
Open parenthesis, 1 plus, another parenthesis, third-party staker rewards at epoch E divided by third-party stake at epoch E, close parenthesis again.
Oh, okay.
Multiplied by the exchange rate at epoch E.
Okay, let's break that down a little bit. What's the significance of distinguishing between third-party stake and rewards? Why separate that out?
Good question. The distinction is important because validators typically earn a commission on the staking rewards that are generated by the SUI that has been delegated to them by other token holders. These are the third-party stakers.
The commission on delegated funds.
Right. They generally do not earn a commission on the rewards generated by their own directly staked SUI.
Okay, that makes sense.
This accounting, which utilizes this single global exchange rate table, allows the Sui protocol to accurately track the rewards earned by both the validators themselves and the individuals who have chosen to delegate their tokens to those validators.
That makes sense. It ensures that everyone's contribution and the resulting earnings are properly accounted for within the system. Clear separation. Now, what are the requirements for someone to become a Sui validator?
Right, joining the club.
Are there specific minimum amounts of SUI needed to participate? How much do you need?
Well, the requirements for becoming a Sui validator are actually in the process of evolving. It's changing.
Oh, how so?
Currently, the Sui network is implementing what's known as SIP 39.
SIP 39.
Okay, which is a significant upgrade designed to lower the barrier to entry for new validators.
Lowering the bar, good.
The previous system had requirements that were based on a minimum absolute amount of SUI tokens that a potential validator needed to stake.
Like you needed X million SUI.
Exactly. The new system, once it's fully rolled out, will shift the focus to a minimum amount of voting power instead.
Voting power. How is that different from just a minimum SUI stake? Is it not just based on SUI?
It is based on SUI, but indirectly. Rather than just looking at the raw number of SUI tokens a validator has staked, voting power takes into account the proportion of a validator's stake relative to the total amount of SUI that is staked across the entire Sui network.
Ah, so it's relative, not absolute. Your percentage of the total stake.
Precisely. Under the full implementation of SIP 39, a candidate who wants to become a validator will need to accumulate at least 3 units of voting power before they can submit a request to join the active set of validators.
3 units. Okay. What happens if they drop below that later?
Good point. If an active validator's voting power subsequently falls below 2 units, they will be given a 7-epoch grace period.
7 days grace.
Right. Which translates to roughly 7 days, given the 24-hour epoch length to increase their stake and bring their voting power back above that threshold before they risk being removed from the active set.
Or warning period.
And if a validator's voting power drops below 1 unit, they will be removed at the end of the current epoch.
Okay, so 3 to join, warning at 2, removes below 1.
That's the gist. This new system potentially allows individuals or entities with a smaller but still significant amount of SUI to participate as validators, provided that the overall amount of staked SUI on the network hasn't grown too dramatically. It adapts.
So it's more about their proportional stake in the overall network activity. How exactly is this voting power calculated then? You mentioned a formula.
Yes, there's a formula. It looks like this. S divided by open parenthesis, S plus T close parenthesis.
That's S plus T, okay.
Is greater than V divided by 10,000.
V 10,000. All right, let's break down what each of these variables represents. What's S?
S stands for the amount of SUI that the validator candidate has staked, their own contribution.
Okay, S is the candidate's stake. What's T?
T represents the total amount of SUI that is currently staked across the entire Sui network by all participants, the total network stake.
Got it. T is total stake. And V?
V is the minimum voting power threshold, which, as we mentioned, will be 3 in the final phase of SIP 39's rollout.
V is the target, 3 units and 10,000.
And the value 10,000 is a fixed parameter within the Sui system that represents the total number of voting power units available in the network.
Ah, okay. So the left side of the equation, S plus T, is essentially the validator candidate's stake as a fraction of the total staked SUI on the network, their percentage share.
Exactly. When you multiply that fraction by 10,000, you get the validator candidate's voting power expressed in Sui's standardized voting power units.
And they need that number to be bigger than V, which is 3.
Right. The validator candidate meets the requirement to join the active validator set if their calculated voting power is greater than or equal to the minimum threshold V.
Could you give us a quick, simplified example to help illustrate how this works? Numbers always help.
Sure. Let's imagine that the total amount of SUI staked on the entire network is, say, 7.7 billion SUI.
7.7 billion total stake.
Okay. And let's say the minimum voting power threshold V is 3, as planned. Potential validator who has staked 2.31 million SUI.
2.31 million SUI stake? Seems like a lot, but let's...
Would have a stake proportion of approximately 2,310,000 divided by 2,310,000 plus 7,700,000.
Their stake over the total plus their stake.
Which works out to be roughly 0.00003.
Okay, a small fraction.
If you then multiply that proportion by 10,000...
0.00003 times 10,000.
You get a voting power of approximately 3 units.
Exactly 3.
Since 3 is greater than or equal to the required threshold of 3, this validator candidate would meet the minimum voting power requirement to potentially join the active validator set.
That makes the concept much clearer.
Yeah.
So 2.31 million SUI gets you 3 voting power if the total stake is 7.7 billion.
Correct.
And as the total amount of staked SUI on the network changes, the actual amount of SUI needed for a validator to achieve the minimum voting power will also adjust dynamically.
Precisely. It floats. And for anyone out there who does have the required level of stake and is interested in becoming a Sui validator,
Yeah.
the Sui team actively encourages participation and provides resources and support for the onboarding process. They even have a link to their validator Discord community within the documentation for those who want to learn more and get involved directly.
It definitely sounds like a very open and evolving system with a focus on broader participation, encouraging new validators.
That seems to be the goal, yeah.
And for anyone listening who wants to really dive deep into all this, get into the weeds, there are a comprehensive set of related links provided within the Sui documentation.
Yeah, they link out to everything.
These cover everything from the foundational economic white paper to detailed explanations of gas fees, the proof of stake mechanism, the roles of the different stakeholders, the specifics of the SUI coin itself,
The storage fund details.
the workings of the storage fund, how validator rewards are structured, the mechanics of staking pools, and the updated validator requirements we've just been discussing.
It's all there.
It's definitely worth exploring those resources if you want to go further down the rabbit hole.
Absolutely. The documentation is an invaluable resource for anyone seeking a more detailed and granular understanding of Sui's tokenomics. Can't recommend it enough if you're serious.
Okay, so let's summarize some of the key things we've unpacked today. We've taken a deep dive into the tokenomics of the Sui blockchain with a specific focus on the SUI token.
Yep, SUI tokenomics.
We've explored its fundamental role as the network's native asset for staking, paying gas fees, and facilitating various applications.
Core utility.
We've examined the proof-of-stake consensus mechanism and highlighted the crucial roles of the three main stakeholders: the users, the SUI token holders, and the validators.
Users, holders, validators. The key players. We've also delved into the four primary functions of the SUI coin.
Staking, gas, asset governance,
The significance of its capped total supply, 10 billion,
fixed supply.
and the purpose behind the carefully designed unlocking schedules, vesting for stability,
We discussed Sui's considered decision not to conduct a mainnet airdrop,
focusing on long-term growth, avoiding bad actors and regulatory issues,
and then spent some time understanding the innovative storage fund.
which not only compensates validators for storing historical data, but also contributes to the potentially deflationary nature of the SUI token supply. Really interesting part.
We looked at Sui's approach to validator rewards,
Yeah.
emphasizing the principle of certainty over randomness,
Predictable rewards based on stake, not luck.
and how validators manage staking pools using exchange rates rather than liquidity tokens.
Simpler accounting, auto-compounding.
Finally, we covered the recent shift towards minimum voting power requirements for becoming a validator, which aims to lower the barrier to entry and promote broader participation in securing the network.
The SIP 39 change, moving to relative stake. So what's the big picture here? Hopefully this deep dive has provided you with a solid foundational understanding
Yeah, good.
of the intricate economic principles that have been carefully engineered to support the long-term health, stability, and growth of the Sui network.
Absolutely. And on that note, here's a final thought for you, the listener, to consider. How might these specific tokenomic design choices within Sui, particularly the unique storage fund mechanism and the predictable validator reward system, how might those potentially influence the future development and widespread adoption of decentralized platforms compared to other approaches you might have seen?
Yeah, how does this stack up against other models? What are the trade-offs?
Good questions to ponder. We strongly encourage you to explore the Sui white paper and the related links in their official documentation for an even more comprehensive and nuanced understanding of this fascinating system.
Definitely check out the source docs.
Thanks for taking this deep dive with us.